Welcome back to Investing Talk podcast. Today we're focusing our analysis on Navitas Semiconductor. They're a really interesting company, kind of riding this huge wave of next-gen power electronics. Yeah, they're central to this big shift, moving away from, traditional silicon towards much more efficient stuff like gallium nitride GaN and silicon carbide or SiCD. We've got a whole stack of recent reports here detailing what looks like a pretty tumultuous last quarter, but also a very aggressive outlook. So the big question we're trying to tackle, the one our sources keep wrestling with, is this. Can Navitas turn its tech advantage into real market dominance? Especially before, well, the cash burn becomes too much, or put simply, is Navitas Semiconductor a good buy right now? Now, before we get into the nitty-gritty of the charts, the balance sheet, all that good stuff, please remember to subscribe, like, and maybe drop a comment on this analysis. And hey, if there's a specific company you want us to look into next time, definitely let us know in the comments below.
That really sets the stage perfectly. Navitas, as we head into Q4 2025, it's got this profile that almost feels contradictory. You've got this mix of, let's say, heightened risk. You saw that in the recent volatility, but also quite significant upside potential linked to things like electrification. So our goal here is really to unpack the evidence, try and figure out its path in the near term.
Okay, let's start with that volatility then. That period between July and September, it looked pretty wild. What was actually driving that sentiment? Traders seemed, well, confused.
Yeah, confused is a good word. What's fascinating is the market was getting these really conflicting signals, you see. Back in early July, the stock had just had this massive run-up, like over 50% in just 2 weeks. Huge excitement, probably about their pipeline. But then late in the month, boom, profit-taking kicks in, maybe some technical resistance, and you get a sharp 2.12% drop.
Right, so a classic setup for market confusion. And you mentioned that technical indicators were almost fighting each other.
They absolutely were. On one hand, momentum indicators were flashing a pretty solid buy signal, suggesting, good long-term potential. But almost at the same time, the short-term traders saw a pivot top sell signal. That's a warning sign. Suggests a pullback is coming if support breaks. And that environment, well, where long-term bulls and short-term bears are battling over the same price, that's just inherently volatile.
Ah, okay. And then August rolls around, and things got even murkier with that management shakeup, didn't they?
Precisely. August saw a pretty high-profile CEO transition. And this wasn't just routine, because it happened right alongside some, frankly, disappointing revenue trends in their quarterly figures. So that combination, it turned what might have been just a revenue miss into more of a crisis of confidence in leadership. Investors started getting really doubtful. Could the new management handle the shift from being an R&D leader to, mass production company? That uncertainty just fueled the volatility all month.
Okay, that really explains the slide we saw in September then. Once that confidence and execution wobbles, any wider market jitters just get magnified, right?
That's exactly right. September just saw the share price keep sliding. I think it was 4 straight days of drops at one point. It ended the month then at $6.43. And yeah, that was definitely amplified by the broader market getting nervous, that whole risk-off mood hitting growth stocks. The focus was squarely on leadership and execution.
But despite all that price pain, the story around the technology itself, that seems to remain rock solid. What are the core arguments the bulls were making? Why did analysts stay interested, keep those high price targets even while the stock was falling?
Well, the core investment idea is almost separate from the quarterly ups and downs. Navitas is fundamentally plugged into these huge multi-decade growth markets. We're talking global EV adoption, building out solar power, the massive need for efficiency in data centers. These are unstoppable trends, and the tech they make, the GaN and SiC components, it's becoming essential, basically non-negotiable for these markets.
So if management can just get the execution piece right, the potential market size is undeniably enormous. Some sources were still talking multi-bagger returns.
They were, and it's all based on that strategic position. If Navitas can nail the execution, especially winning big contracts in EVs and data centers, the potential for revenue growth just dwarfs the current financial struggles. The tech really is leading edge for efficiency and size.
Okay, connecting this to the bigger picture, the fundamentals, they paint that classic but difficult picture of a high-growth disruptor, don't they? We know these companies often trade on future promise, not current profits. What are the key numbers we should really focus on to grasp that financial tension?
Right, you have to look at what I'd call the growth paradox. So on one side, the trailing 12 months revenue, TTM, was $68.17 million. That shows solid double-digit growth year over year. It proves their tech is actually moving into the mainstream, which is great. Plus, their gross margin, around 27%, it's competitive. Shows they're managing costs reasonably well for a company still scaling up production.
Okay, those sound like positive signs. Good product, decent margins starting out, but then, yeah, that bottom line figure, that net profit margin is just,
Real.
wow.
It is, isn't it? That's the other side of the paradox. The net profit margin is deeply negative. We're talking negative 182.63%. And the earnings per share, the EPS, is minus $0.58 TTM. It looks staggering, but it's not a typo. It reflects the massive upfront spending on R&D, on manufacturing, everything needed to grab market share from the big established silicon players. They're basically choosing market dominance over short-term profits right now.
Okay, and this is where it gets really critical for me, the balance sheet. A negative 182% profit margin means they're burning cash like crazy. You mentioned the TTM loss was, what, negative $124 million. A company can't just keep doing that forever. How can they possibly sustain that kind of cash burn?
Right, and that's where the balance sheet offers this crucial reassurance. It's really the bedrock of the whole bullish case. Navitas is entirely equity financed. What that means is their debt-to-equity ratio is effectively zero. Zilch. The insight here is profound. The market is only tolerating this massive cash burn because that zero debt structure buys them time, years of operational runway potentially.
Ah, okay, so no debt means no immediate liquidity crunch, no interest payments breathing down their neck, no restrictive debt rules. That gives them a lot of flexibility, doesn't it, to keep innovating or just ride out market storms?
Exactly. They're not answering to creditors. That gives the new management team the strategic breathing room they need to keep investing heavily. So even with that $124 million TTM loss, they've got a cushion against market volatility. And that financial structure, that's precisely why analyst sentiment is still so bullish. You've got, what, 5 out of 7 analysts rating it buy or strong buy. They're betting on rapid revenue growth and eventually, reaching normal profitability in the next couple of years.
Okay, so shifting from that crucial safety net on the balance sheet to the charts, what are the technicals telling us about the stock sitting near that $6.43 low from September? Are traders finally throwing in the towel, or are they maybe quietly buying the dip?
Well, the technical picture is actually saying that despite all the recent price chaos, the smart money, the professionals, they might still be quietly accumulating. If you look beyond the day-to-day noise, the stock's actually formed a technically bullish pattern since June, higher lows and higher highs. That confirms the underlying long-term momentum is still pointing upwards.
So the overall trend is up, even if the ride has been bumpy lately. Where are the key levels, the sort of lines in the sand that traders are watching right now?
The key support zone is actually quite tight, right around $6.40 to $6.78. That area is significant because it's near the 50-day simple moving average. That 50-day SMA often acts as a kind of psychological dividing line. Holding above it suggests short-term bullishness. If that support holds, the next target on the upside is resistance around $9.40, which is the top of its recent trading range. And critically, the overall momentum indicators. Overwhelmingly positive. Something like 12 out of 17 technical signals are saying BUI. Both the 50-day and the 200-day moving averages confirm a strong long-term uptrend is still in place.
Interesting. That paints a picture of a stock with a solid technical foundation, maybe just waiting for a fundamental spark. But let's zoom out again. Why Navitas? Why are they seen as a future leader? I mean, the big legacy silicon companies have enormous manufacturing scale. How strong is this technological moat they have? Can it really fend off competitors if a giant decides to jump into GaN seriously?
That's absolutely the right question. And the moat seems pretty deep, primarily based on their established tech leadership, gallium nitride and silicon carbide. These aren't just slightly better versions of silicon. It's a fundamental shift, a secular change in how power components work. These materials let devices switch electricity much faster, much more efficiently than silicon ever could.
And what's the practical benefit? The thing you or I might actually notice.
The real-world benefit is huge. GaN and SerT allow power systems, chargers, converters, that sort of thing, to be way smaller, lighter, and run much cooler. Think about those tiny laptop chargers you see now, maybe half the size they were 5 years ago. That's GaN in action. And this is absolutely critical for things like fast charging in EVs, where every ounce and inch counts, and also in giant data centers trying to slash their massive electricity bills. Plus, Navitas benefits from having a pretty extensive portfolio of patents protecting their designs, which helps secure those design wins.
Okay, sounds like the tech advantage is real. So looking ahead now, this is critical. We know the history, the finances.
Yeah.
What specific dates should people be circling on their calendars over the next, say, 3 months?
Right. The absolute pivotal moment coming up is October 15th, 2025. That's the Q3 earnings release.
Yeah.
Given the CEO change and all the recent volatility, this is the immediate litmus test. We need to see if those strategic shifts are actually starting to boost revenue again, especially in those key markets like electric mobility and energy, where they claim to have the edge.
Got it. Q3 earnings on October 15th. What else is on the radar? Any other market events that could inject some volatility or maybe show us what the big institutions are thinking?
Yeah, there are three other things to watch. First, November 1st, there's a potential ETF rebalancing event. Those can always shake things up a bit, affect liquidity. Then, November 25th is the deadline for institutional 13F filings. That's when the big funds have to reveal their holdings. It gives us a peek into whether the smart money was buying or selling during that recent price dip, which is always valuable info. And finally, December 18th, there's usually a sector report around holiday demand for power components in EVs. That could give us a hint about downstream demand heading into 2026.
Okay, those are the known dates. But what about the whispers, the industry chatter? That's often where the really big potential catalysts, the upside optionality you mentioned, actually come from.
Oh yeah, there's definitely some buzz floating around that could really change the narrative quickly. One rumor that keeps popping up is that Navitas is supposedly in advanced talks with a major EV manufacturer, an OEM, for a big multi-year supply deal for their GaN and power chips. If something like that gets announced, wow, that would instantly validate the new leadership and prove they can scale up for the huge automotive market.
Okay, that would be massive. What about M&A, acquisitions? When you have disruptive tech like this, sometimes the big guys just decide to buy it instead of building it themselves.
Exactly. And there is market rumors suggesting potential M&A interest from a large established semiconductor company, the classic defensive move. They'd be looking to quickly bolster their own EV and data center offerings by just buying Navitas' tech and patents, skipping years of R&D. And lastly, there's also some chatter about a major customer win in the cloud data center space. Specifically, that Navitas might be in trials with one of the big hyperscale providers. Now, if that trial turns into a real contract, that could mean a massive ramp up in volume starting maybe early 2026. That would drastically speed up their path to profitability. So, just to kind of pull it all together, Navitas Semiconductor sits at this really interesting intersection. You've got rapid revenue growth potential, clear leadership in next-gen power tech, and as we saw, strong underlying technical momentum on the charts. The overall investment case, you could rate it highly, maybe 9 out of 10, bullish, mainly because of that zero-debt safety net and those undeniable long-term trends like decarbonization.
But, and this is a big but, that high potential comes hand in hand with significant execution risk and, well, those eye-watering financial losses for now.
Right. So what does this all boil down to for you, the listener? This is clearly a story driven by technology with potentially high rewards, but also very real risks. It seems like the stock could appeal to different types of investors. Short-term traders are probably laser-focused on that October 15th earnings report as the next big catalyst, whereas long-term investors are likely betting on those big structural shifts like electrification playing out over the next 5 or 10 years.
Which brings us to maybe the final thought, a question you should probably ask yourself if you're considering the stock. Given that zero debt structure, that equity financing,
Yeah.
how much weight should you really put on their ability to eventually capitalize on these huge multi-year trends like decarbonization and electrification, even knowing that achieving that global dominance might mean accepting years of continued losses along the way? That's the fundamental tension here.
That really is the key question, isn't it? It's at the heart of so many disruptive growth stories right now. Well, thank you for joining us for this analysis today. We really hope digging into this helps you become a more informed investor. We'll see you next time on Investing Talk Podcast.